Welcome to the Options Income Blueprint Weekly Income Report. This is Michael Schulman on March 21st, 2022. A reminder, we have a session tomorrow at 11 Eastern Daylight Time. I want to go over our trades and results from last week, our net debits and our paper losses, and what exactly happened with Squarespace and where are we going with it. Last week was a modest week. Fed meeting. Market uncertainty about Ukraine. We've pulled in a little bit, but that does not mean we're not producing cash. We're closing positions earlier. I get a lot of emails. Why are we closing early? If you're not willing to give up a nickel or $5, you're asking for trouble. It's very important that you be aware that the market can dictate. Anything can happen, and that since the market is nervous and is dictating, the rationale behind the stocks right now, meaning their quality of the company, the quality of the stock, the value of the stock, that can play second fiddle to the need to be very conservative and to protect your position by closing early. As you can see, we sold one position and we rolled another because many positions had already been pushed out. But we did have very, very, very good rates of return on both of those. And of course, when you're managing from a position basis, this is what you're looking for. We got our 0.5% return by getting in and out of Micron quickly. I assume we're going to do it again. And by rolling out a couple of weeks, we had a rather high rate of return. If you divide that out by a couple of weeks, you end up with still 0.8, 0.85% rate of return on a roll. That's terrific. So we underperformed, quote unquote, the goal of 26% annualized cash rate of return per week. But when you take a look at how we've done, even since things began to weaken in December, cash rates of return are elevated in part because we're good at what we do, and in part because of market volatility giving us higher premiums. They may be coming down a little bit as we use good until canceled orders and as we close early, but that too may begin to fade depending upon if the market shows the same kind of stability that it showed last week. And there's the overall performance, a different way of looking at it. We didn't sell any shares, but that's how we did. Speaking of last week, we got a lot of clarity from the Fed. The Fed stated up front they would raise rates for each of the next meetings, which would mean 6 for the year. And combined with murkiness and shock in Ukraine, if you said 2 months ago this was going to happen, you would assume there'd be a big market sell-off. But it did not happen. The bond market was predicting somewhere between 4.5 and 7, depending on the analyst. The numbers were about 4.5, but the bond market did not move, barely moved, when they said there could be as many as 6. And there's a couple of reasons. One is a flight to security, treasury bills, keeping bond prices in line because of Ukraine. The second is Powell was pretty quiet but definitive in saying he's going to be, and the Fed is going to be, data dependent. What does that mean? If the economy stalls, if inflation tames faster than the Fed is predicting, and so forth and so on, the Fed might back off a little. That he did not say he would back off, but that's how the market interpreted it. And the question is, will the positive tone continue? We know what the Fed's going to do. Well, now we have to know what Vladimir Putin is going to do. So to that point, I want to segue over to tactics a little bit, and in one position in particular, and that is, I do get emails, and this is almost exclusively from people who are new. So I hope you're listening. Is my God, this position is down. The broker screen is flashing red. Why are we still in this position? Well, paper losses are just that. They're on paper. The way I do it and the way I urge you to do it is a loss is not a loss until we say goodbye to the company and the stock. And when we carry over a paper loss, we call it a net debit. That's the Wall Street term. And managing net debits, there are a variety of reasons to do so. And the one reason not to close a position is emotion. It's very, very understandable that when something has hit you hard, you want to walk away from it. I get it. And if you're a trader, of buying and selling and buying and selling and buying and selling, a swing trader, day trader, and you come to this service, you may be used to taking losses. The typical successful day trader has a 70-30%, 70 to 30 um, proportion of wins to losses, but they get hammered, creamed in in a situation in a market like this, which is why we use net debits. In fact, let me drift for a second. As you know, I'm in Rome, and I was at a restaurant which has a food bar, meaning it's a real restaurant. But if you come alone, there are 6 stools, and a couple next to me, both professionals, a PwC guy and a Google woman. And the PwC guy's hobby was trading, so we fell into conversation pretty quickly. And he said he got creamed, but he was a buyer of options. He was a hobbyist part-time day trader, and you hit one bad bump like we saw in 2020 when the lockdowns were announced, or you saw with Ukraine, and it was pretty much wiped out. So when you're doing what we do, which is selling options based on the long-term quality of a company, a stock, you avoid that. You may be down, and an individual position may be flashing red, and the overall portfolio value may be flashing red, but we're still focused on generating cash. So at the end of a quarter, well, and preferably at the end of a year, we're still considerably ahead of everybody else in the market. So a net debit is really the Wall Street term for a paper loss, where you're carrying over the position and you continue to trade it. And so it's all there in front of you. You are put shares, you sell a call, you have a paper loss, and so forth and so on. But you keep the trade going and you whittle away. And you'll see in some of the tracking that we do, for example, in a Squarespace or Sunrun, if we were called out in April, we have April positions on. Well, we don't have April positions on yet. Excuse me. If we're called out, or when we're called out, we would be using a net debit to track how we're doing. So, why would we continue? And I'll talk only about Squarespace today. Why would we continue with it? We have a cost basis of $39.25 and a rather large paper loss. So the company is still clicking pretty much on all cylinders, just not to the extent that the most hopeful on Wall Street, who saw the company exploding during the pandemic. The company really serves gig workers, small and medium-sized business, and added an e-commerce component to what it does. And this is where the trade has happened. We had excellent excellent earnings based on history pre-pandemic. The earnings disappointed in post-pandemic expectations, and the stock got hammered. Remember, we entered it after the last earnings announcement, when the stock was up in the 40s, and Wall Street was very, very happy with the results. So you have to take a look at the company before you decide to stay in a position and maintain that net debit, or to say goodbye and move your capital over to another name. So there's a continuing and ongoing shift in the internet in gig workers and small businesses, and it's a market leader in this demographic because of its ecosystem. And the stock has been hammered, but has found some stability. The chart is ugly, and the monthly options are somewhat illiquid, but there's huge potential returns on capital. You can see what I mean by an ugly stock. That we created, money came pouring in. That looks like a flash trade, and then we're up and down with the market, and then so forth and so on. But let's take a look why we're sticking with it. The value of the position is what you can sell the shares for. I cannot emphasize this enough. It's not your cost basis, which I get email after email going, well, we have it at 48 and the stock's at 32, I'm getting out. Well, the answer is no. I mean, your equity capital is worth $32 a share, and that's what you base your math on. So enormous rates of return if you were called out, and still very high rates of return if you're not. There's an exogenous factor, which if you've taken the training program, or if you're an income masters and listen to six-figure portfolio coaching, I don't take losses in good companies. I preach, and it's kind of an ugly word, but I preach patience. I don't like it when people do it to me, but here you have to calculate the cash rates of return juxtaposed against the potential upside of the stock. And the issue for us on a Squarespace or a Sunrun, to the positions that are well underwater and options like a blueprint, is Wall Street permanently repricing the valuation of the shares? Meaning, does it have to have 25% growth, 30% growth in order to return to the levels that Wall Street assigned to it during the pandemic? We won't know for another quarter, but we can trade that quarter until we find out. And we'll see how the market reacts to the next earnings announcement. And then if we have to take a loss because it's going to take too long to get back, even if we're getting high cash rates of return, if I think the stock is dead money, then of course it would be time to move on. And so going forward, those two difficult positions, again, I'm referring back to the company, the trend, the real world, and that's what we're going to be doing. We're going to focus on cash first. They both have very high cash rates of return, even if calls and puts that we sell expire worthless. And we have to examine, of course, what happens to them over time. This is Michael Schulman. Thanks for listening.